Is China's vast economic empire crumbling to dust? Will the country's former economic clout prevent its economy from crashing down in 2023? As the Chinese economy tries to walk the dangerous tightrope to steady its financial footing, we will tick off the factors that led to all its major economic sectors losing steam. Join us as we turn the page on this dark economic chapter. An unsteady China with a plummeting currency, a tumbling property market, and subpar industrial output. Post-COVID boom. What initially promised to be a period of economic boom turned out to be a tiny blip on the radar in 2023. China's economy looked all set to return to its pre-pandemic glory after the lifting of COVID restrictions. However, matters sizzled and fizzled out much sooner than expected. Emerging data is not looking positive for PRC. Simply put, the new economic climate of China is riddled by a host of complex macroeconomic problems and issues. Topping the list is China's ailing property sector that needs serious financial CPR to be revived. There's also the lackluster pace of economic growth that fell miserably short, failing to nail expectations. The grim picture does not conclude here. The mighty yuan is sliding downward, caught in a spiral of deflation. And to top it all off, fresh college graduates are left twiddling their thumbs given the dismal state of the job market. There simply aren't enough jobs to go around to match their skill set. China's post-COVID rise is a flimsy myth that simply could not live up to the hype. When it comes to industrial output, it's more of the same. The theme of an all-around economic disaster does not shift or budge. Take the case of Chinese manufacturing, for instance. Things have taken a downturn. The sluggish global economy has not been kind to the Chinese. The demand for Chinese goods has plummeted owing to the slow pace on the global front, and Chinese exports are no longer selling like hotcakes. It's a classic case of the ripple effect. Industrial production in China has shifted to slow gear. Industrial production growth data nosedived to 3.7% year-on-year in July and has slowed down considerably from its 4.4% rise in June. This is a far cry from the estimated forecast that stood at around 4.3%. Chinese manufacturing is being crushed from all corners and is now suffocating under a period of contraction. Yes, post-COVID euphoria and the 3 months of expansion that subsequently followed have now been all but snuffed out. Chinese manufacturing has been performing poorly with deteriorating activity for the fourth consecutive month. Could it be the final nail in the coffin for Chinese makers and manufacturers? According to China's PMI stats from July, the reading obtained fell lower than 50. That does not paint an optimistic picture. Trailing close behind is China's Caixin manufacturing PMI. Small-scale businesses and private firms engaged in activity associated with exports in the PRC fall under Caixin's umbrella. But the Caixin's index is not looking any better either. It presents a picture of impending doom and has been struggling with a contraction in July. What are the factors that led to Caixin's index being trapped in an economic chokehold? It all boils down to the fundamental factors of supply and demand. Waning PMI numbers point to a drop in both, and the consequences are dire. New orders have experienced a sharp decline. Not only that, output has also dropped, pushing Chinese manufacturing into this undesirable phase of contraction. Clearly, it will take a Herculean effort and more than a monetary incentive by the Chinese government to pull the country out of its current economic mess. The yuan's new low. China is not out of hot water yet. More bad news is on the cards. This time, it's the Chinese currency that has been hitting the headlines for all the wrong reasons. In mid-August, the yuan plummeted to a new low, the biggest one in a period of 6 weeks. China has been mired in financial setbacks and challenges. This is ringing the alarm bells for investors who are wary of acquiring yuan assets, especially against the backdrop of the chaos that engulfed property developers' repayment. Investors are also turning their backs on the idea of investing in the shaky and unpredictable Chinese economy. The Asian tiger has been declawed and defanged. It plunged into a cycle of deflation in July. This was a bleak point, with China being dealt a double whammy. Both producer and consumer prices dropped down at the same time, something that had not occurred since November 2020. As prices around the world skyrocket and go on fire, China's current deflationary dilemma presents an interesting thinking point. It is indicative of the deep-seated issues that are oozing and festering in China's economic infrastructure, and without a band-aid. Consumers are reluctant to spend given that their confidence in the economy and its recovery process has been severely dented. The deteriorating state of the property market has been a key factor in molding the consumer's mindset and approach. Chinese bank loans also experienced a drop from June to July. New bank loans fell by the wayside. They shrank by 89%, amounting to 345.9 billion yuan. The prognosis does not look good. This unfavorable development materialized even though interest rates were slashed. Promises to offer greater backing to the economy were dangled like carrots to spur more activity. It was in the year 2009 that a reading as low as this was rolled out. It defied all the speculations put forth by analysts. Experts in American economic circles have chimed in. They have delivered the verdict. Weak credit demand from Chinese households as well as the corporate sector has been showcased by credit data from July. Challenging issues are only mounting and piling up. It is becoming difficult for China to climb the rocky path to the summit of economic success. Other elements have also come into play with full force to exacerbate the deflationary cycle. The combined commotion has sent China's economy crashing down like a stack of dominoes. For instance, the price of energy commodities have nosedived in the global financial arena. In order to get rid of the ever-piling stocks of consumer products since the pandemic, consumer goods companies are doing damage control at slashing prices left, right, and center. And that is just the tip of the iceberg. Car manufacturers are locking horns over prices. The Atlantic Council is already raising the question of economic reforms. It cites Pathfinder, which shed light on a 2022 speech delivered by the Chinese President Xi Jinping. The speech was published in the Communist Party journal Qiushi in June 2023. President Jinping's speech touched upon key points such as economic restructuring. The leader also dismissed the use of old tried and tested methods along the lines of shoring up projects. He also cast aside the notion of promoting disproportionate borrowing or pouring funds irresponsibly into investments. These methods might have worked for the People's Republic in the past, but this time around they might not provide the answers or solutions that China is seeking. The property debacle. China's property market seems to be sailing through stormy weather. Country Gardens is one of the PRC's biggest names when it comes to property developers, and yet this real estate giant is on shaky ground as it tries to evade a default on its bonds. This signals an alarming dip in the property sector, fueling fears about China's impending economic catastrophe. Country Gardens Holdings has been dealt one of their biggest blows with this latest development. According to the developers, they have not experienced such a formidable challenge since 1992. That's the year of their inception. The giant made a fatal error when it came to gauging China's current market decline. As it is, at the end of 2022, their total liability stood at a staggering 1.4 trillion yuan. After enjoying the fruit of their earnings amounting to 1.91 billion yuan in the previous year, the company is expected to stomach an overwhelming loss of 55 billion yuan in 2023's first half. Liam Go of UAB Asset Management did not mince words. About the news that emerged from Country Gardens, he proclaimed that it only served to cement investors' fears about the disastrous state China's property market finds itself in. According to a report by Fortune, the controlling shareholder of the company is poised to declare a multi-billion-dollar loss for the first half of 2023, and the wheel does not stop turning here. Country Garden Real Estate Company Ltd. is putting a halt to trading in various onshore bonds. The Chinese government has been trying to pump up demand in the property and real estate sector. Steps have been taken on varied fronts to breathe life into the struggling market. Mortgages have been pared back to facilitate first-timers when it comes to buying homes. And yet the situation seems to be getting more dire by the minute, with the real estate market drowning in an economic sinkhole. It has been a free fall for new home prices for 16 consecutive months, including in December 2022. They seem to be up in June, but then resume their characteristic decline. Bolstering demand is not going to be an easy feat for the Chinese. The real estate sector makes up a significant chunk, making up a fifth of the PRC GDP. Tommy Wu is an economist at Commerzbank AG. He cannot overemphasize the need to bail China's real estate sector out of its current deplorable state. For this astute economist, China's post-COVID recovery translates into a consumption recovery. The sale of houses deteriorated the most in July 2023. Country Gardens' fumble will cast a dark shadow on the already flailing economy. According to Wu, it will exert further pressure on an economy that is already slowed down. Analysts at Nomura have dropped hints about Beijing acknowledging that the property sector needs a boost. It is the need of the hour, and Beijing is stressed when it comes to this sector. However, the analysts have still pointed out that Beijing so far does not have a clear policy blueprint to bring about this proposed boost. In fact, the government is now looking at large cities. It might even go as far as to provide incentives to launch redevelopment projects in the old districts of these cities. The Chinese Prime Minister Li Qiang was vocal during a state council meeting to take measures in terms of optimizing and adjusting policies to keep the property market on a stable keel. In order to quell the liquidity crunch in the real estate sector, the government had also declared a 16-point plan in 2022. So far, however, China's real estate sector appears to be a dead horse. What do you foresee in the near future for the Chinese economy? Do let us know in the comments below, and stay tuned for our next video. Until next time.